Phillips, fixed income manager at Liontrust, is our guest today at the FT headquarters as we discuss the process of how bonds are chosen and vetted for inclusion in portfolios. Donald, do you have some preferred sectors which you're investing in?
We're bottom-up bond selectors, really. We're looking for good individual idiosyncratic stories. We think avoiding accumulations of thematic risk, like energy, like mining, even banking. You know, in 2008-9, there was systemic risks in the banking sector that exist to this day, where the bonds in that sector rise and fall together. So our portfolios consist of really avoiding accumulations of sectoral thematic risk.
So active bond managers have entered an era where they're behaving more like equity managers, where they're choosing individual stocks or bonds based on their characteristics.
I think that's true depending on the active manager. There's certainly value to be added to clients, certainly in the high yield market, from a bottom-up, almost equity-like, company fundamental research. Because at the end of the day, in a high yield portfolio, the outcome will be, if you avoid defaults and invest in solid borrowers, over the long term, you'll produce good outcomes for your clients. So therefore, all of the risk lies within the companies that you lend to, the companies you invest in. And everything else around that externally is just noise. So yeah, a more equity-like approach in the high yield market is appropriate.
So what kind of characteristics are you looking for in the company that issues a bond before you invest?
I think like any active manager and any analyst, they'll tell you that you're looking for competitive advantage, you're looking for evidence of sustainable competitive advantage, and we're no different in that regard. You're thinking about the key risks in any industry and how that can impact default risk to the company. But I think one thing that we really focus on through our experience in investing in high yield bonds is the balance of interests around different stakeholders in the business, what we call the motivations, and understanding how the managers and owners of a business and how they're going to manage that business, how that impacts creditors. You have found historically is quite a lot of LBOs in the high yield bond market, quite a lot of financing of LBOs, where if you were being a little bit unkind, you might accuse the private equity owners of these businesses of being relatively short term, maybe a 5-year cycle, depending on the private equity funds that they're commercially selling to their clients. And that's not always the best long-term outcome for creditors, to be aligning yourself with that type of owner of a business. So we have a real focus on those motivations, and how that actually impacts the portfolio is 85% of our high yield bond fund is in listed stock market shareholder-owned businesses with the transparency and, I would argue, greater long-termism that comes with that relative to private equity LBO type.
So can you give us some examples of which particular companies you'll be recommending for portfolios?
One of our favourite holdings that's held in our high yield bond fund and indeed our strategic bond fund is Netflix. To many, Netflix shouldn't be a bond investment. Netflix has borrowed lots of money to pursue rapid growth, spending money on television and film content, and then attracting customers to a subscription-based revenue model. But they, to this day, have been a negative cash company because they invest so much in content that, at the end of the year, they are still in deficit in terms of cash. And for many, that's the reason why it shouldn't be a good bond investment. But we actually take the view that Netflix can turn off that spend. 12 to 18 months can significantly reduce that content spend if they need to in a pinch. In the meantime, they are a non-advertising based media company. Isn't that fantastic? You don't have to rely on the cyclical whims of how much businesses are spending on advertising. You have your clients paying you their monthly fee. And I would argue that the next recession, because Netflix hasn't really faced one yet, people probably stay at home and watch Netflix and don't go to the pub or the restaurant or the cinema, perhaps. So you'll find it's actually quite a recession-proof business model.